Morning, everyone. Thank you for joining us for our Lessors Risk Product webinar. My name is Anae Augustini. I'm CEO of CID Insurance Programs, and I am going to be one of your instructors today, along with Michelle Belden, who's our Lessors Risk Underwriter, and she will be co-instructing with me today.
Everybody.
Also, Kaylee Bolger is our marketing coordinator, and she's making sure that everything runs smoothly for us. And she'll be making sure that all your questions get over to us and we get those answered. So if you have questions, we'd be glad to answer your questions as we go along. It probably will be appropriate. So if you want to type them in, we'll make sure that we get those answered for you. Also, we'll be taking questions at the end as well, so that should make it really a little bit, give you enough time to ask questions. So let's get started. So let's talk about webinar objectives. But first, I just wanted to say, I've probably been in this business about 30 years, and in that time, when I can remember back to when I actually did commercial retail, and so I clearly have an understanding of where you guys are working day in, day out to obtain new business, new production for your business. So what I learned is that I didn't know a lot about commercial buildings or residential buildings and how to insure them. But I quickly learned that was a fast source of respectable premium. You can write a $500 policy or you can write a $3,500 policy. And I learned that you could build your book faster by going after commercial building insurance or residential. We'll be doing a webinar on residential a little bit later. I think it comes up in October, so look forward to that. So let's talk about what our objectives today are. What do I want you to get out of this? And the important things to learn are that to understand and recognize that there are different types of commercial buildings, and that's the first thing where you would be wanting to start. What underwriting guidelines need to be considered? So what's going to be what criteria are you going to use to decide whether this is a building you want to even attempt to insure or not? Third, I want you to be more knowledgeable about product components and how to insure them, best to insure them. And then last, Michelle's going to talk to you a lot about how to prepare a quotable submission so that you can get a quote fast and efficiently from her. So let's get right into the meat here. So let's talk about Lessors risk definition. So Lessors, the LR, and it's the techie term is LRO, Lessors risk only. And what this is from an insurance standpoint is that it's going to provide the liability and property coverage for building owners, commercial building owners, who lease out their entire building or occupy. So they are going to have tenants, and they're going to be business tenants that they're going to be leasing their units out to. Or another lessor's risk definition is the owner can occupy up to 75% of the building, and then lease out the remainder portion. So any greater than that, then it won't be considered a lessor's risk because the majority of it would be owner occupied, and that would not qualify for a lessor's risk. So think of it as landlord's insurance. It's where building coverage is required, and the business personal property is optional. So meaning that you're not insuring the tenant, but you are insuring the building owner, the structure that houses the tenants. And that's an important distinction. I know, Michelle, you end up with confusion all the time with brokers relative to where they are looking to insure a business that's inside of it where the landlord is requiring them to get insurance. Is that correct?
Yes, I do see that. I wanted to add to this. So if you're confused on determining if it's owner occupied or if they have its owner, they own it and then it's tenant occupied, I always suggest to brokers to find out who is on the title of the building. That's the best way to determine if it's, an individual, then it's pretty obvious that they're renting it out to somebody else. But sometimes, a building is owned by a corporation or an LLC, and that corporation or LLC is actually occupying the building. So in that case, it wouldn't be considered a lessor's risk since the same entity owns the building and is occupying the building. So you just need to learn to differentiate between who's truly the owner of the building and then who is occupying the building. You could be a building owner and own the building in the name of an individual or a trust, but then you could have your business that is a separate entity that's an LLC or a corporation that occupies the building, and you would be considered a tenant. Your business would be considered a tenant, and you're leasing back to you as the building owner.
Okay, so that's very good, and a good point to make, Michelle. So we have a question. What if the LLC owner of the building is also the major tenant at 93%, but the business is a completely different entity? So I was just going to answer that question. I was going to add to your point, Michelle. If someone owns the majority of the building, over the 75%, and they occupy the building, then you would be insuring the business, correct, Michelle?
Yeah, if they are the same entity.
And then including the building coverage.
Correct. But if they are truly two separate entities, then yes, you would be splitting it out and it would be considered an LRO. But if it's the same entities, if it's majority ownership owns the building and is also is also considered the tenant, then you would be putting it on the business policy for the property coverage.
Okay, good. It's a good start we've got. So let's start with some basics here. So let's talk about types of lessor's risk buildings. So in the underwriting world of what I call lessor's risk buildings, you're going to have different types, and the rating factors by carriers can vary in this arena. Let's take, for example, a professional office building. There's probably going to be less exposure because you don't have any kind of manufacturing type exposure. You've got people going into an office building and staying there for usually 8 hours and working in offices. And so the office buildings, professional office buildings, are probably a more preferred risk that there's a lot of competition out there for. Then you have commercial buildings, and there what you're going to see there is, because commercial insurance is a term, right? So what we mean by commercial buildings is that it's light industrial. It could be light manufacturing, where you're going to have more trades, artisan trades, or types of services where there is more activity going on and potentially more exposure to property perils and general liability perils that each of those businesses could bring forward. We'll talk a little bit more about what some of those, more detail on that a little bit later. Mixed-use buildings. Do we have residential and professional buildings, or even do you have residential, on top of commercial? And so that you need to know what you have as tenants in those buildings. Also, retail strip malls, same thing. That's going to be usually services and retail stores. And then last but not least is business park associations. They can be condominium, or they can be single buildings that are individually owned parcels by the membership. So this is a nonprofit, just like a condominium association or a planned unit development. But now the building departments are requiring people to build them like this, just as they sort of converted over all of the residential building. They're now taking the commercial buildings and taking them in that direction. So important to understand what type of building you have. We've got some examples of pictures here just to give you a feel. I lump together the professional building and the business park associations because typically they're going to look something like that. You know, the business park, it doesn't, in those situations, usually those, you know, you're either buying a unit inside as a member, and the association itself would be insuring a structure like this because you can't insure it individually. So they would need, the association would be responsible, just like a condominium association. That's where the structure becomes common, the big building becomes the common area and it's insured by the association. Professional building that has a landlord, then he's gonna carry, that's a lessor's risk, and they're going to be carrying the insurance. And then you would have this looks to me like it's a professional office environment. So retail strip mall, everyone gets the feel for what that is. That is actually where you've got your retail stores, usually a lot of foot traffic going in and out of retail stores, so that there's considered to be a higher general liability exposure there. And then here's an example of a commercial building. Typically, this is what a lot of them look like. This could be an office building, but a lot of these are, they've got back big roll-up warehouse doors in the back, and a lot, you know, service type companies where they have lots of trucks going in and out, you know, or you could have light manufacturing or assembly going on in one of these buildings. Mixed use buildings is also, here's an example of that, where you've got your retail, or it looks like there's a sports bar on the bottom floor, and then you have, it looks like residential on the top. Okay.
All right. So I just want to go over some underwriting guidelines to consider with you guys. And Nate was just talking about the different types of buildings. So professional buildings are definitely our most preferred class. You don't have as much foot traffic as you do in a retail or even a mixed use type building. So it's knowing what type of classification they fall in. You know, sometimes it could be in the middle, but that's why there's the range of them that we can do with. And also, she was talking about the commercial buildings, your light manufacturing things. So those would be artisan trades. You could have a contractor, any type of like warehouse occupants who, you know, maybe they have a retail storefront somewhere, but then they have a warehouse where they're storing all their goods that they are using. And so that could be another type of a commercial building. So the light manufacturing are more preferred classes for us. It's when you get into your harder to place occupancies. Those could be garage type risk, restaurants, furniture manufacturers, things that have a higher hazard that could definitely make the building a higher hazard. I mean, if you have a wood manufacturing in a building, I mean, there's a greater opportunity for, if there was a fire, for the building to go up in flames, and then you have all the product that's in there that's wood related. That's just accelerant to the thing. So there are different things to be looking at and considering the tenants and whatnot. So some of our carriers, I know for a fact, won't accept furniture manufacturer tenants, and then others will. So it just kind of depends. Your harder to place ones generally go to more E&S type markets, and they will determine if we consider it or not. You know, your E&S type markets are going to be more expensive, and they're not going to be like your typical preferred markets as you would see with like Travelers or Nationwide or AmTrust. So they definitely won't be written on a BOP or anything like that. So you would be getting a commercial package, and it won't have all the bells and whistles that you would see on a preferred policy. But again, it's just knowing the types of tenants and then how we can place them is what I'm here for. I'm here to look through all of them and see what we have and try to help you guys find the best market for the client that you have. Some other things that you should know about are a rent roll. it's something that if you have, I mean, most landlords have some sort of rent roll. They need to be keeping track of who their tenants are in the building and what and the square footage they're occupying and things like that. So for me, a rent roll is actually really helpful to provide and determine what markets I can place coverage for you for. So for us, on a tenant rent roll, I'm looking for the tenant's name, a description of the business that's occupying the unit, and the square footage that they occupy. And then, so that will help me determine where I can place a market, because I have to know the tenants in order to place a market for you. And then lastly, we can do LROs that do have vacancies. Most of my markets go up to 30% vacant. I do have a couple E&S markets that will consider up to 60%. It just kind of depends on, how long they've been vacant. The landlord or building owner is actively trying to obtain a tenant to get in there, or for what reason it's vacant. So we can consider LROs that are vacant. Now you can go to the next slide. Some other things to consider as well. We actually are really good at older buildings that do have updates. So, and when I'm saying older buildings, it can be in the early 1900s, in 1920s, things like that. But what we're looking for is updates generally within the past 30 years, and are on the older buildings and even newer buildings, things like that. We're looking for building owners who have pride in ownership in their buildings, who are well maintaining them. So we don't want dilapidated buildings and things like that, things with, a lot of
that have not been maintained.
Thank you.
We have a question here. Someone's asking if we would define E&S market, and I just want I could go ahead and answer that. So we have preferred and standard carriers. Their appetite is going to be more towards professional buildings, some commercial, really light manufacturing, as Michelle said. However, when you get into harder to place because of the exposure is greater, what we mean by E&S is excess and surplus markets, and they're really designed to actually be a catch-all for those types of buildings that don't fall into the preferred range. And so we call it E&S markets for short, and usually many of them are non-admitted carriers, and your rates are probably going to be a little greater because of the fact that they're a higher exposure. So I hope that helps. Let me know if you have a further question, type it in.
All right. So talking about the age of the building, building updates, we are on the older buildings, and we're looking for updates to the plumbing, the wiring, and the roof. Most carriers are between 25 and 35 years for their updates, and the updates actually will help determine if it qualifies for special form with replacement cost, or if there haven't been any updates within the said carrier's range that I could take a risk to, they would most likely be offering basic ACV. So you're looking to maintain the building, making sure that you're up to code with things. So the building upgrades, you're generally doing that to make sure that your building, as the building owner, is keeping their building up to code. And then we're just keeping the building maintained, because unmaintained buildings tend to have a greater opportunity for a loss. And all of the carriers that we do write LROs through, they will perform an inspection on the building. And if it comes back with loss control recommendations, it's just ways to help the building owner maintain their building to help prevent them from having any type of loss.
Okay. We have another question. Some LRO customers claim they don't need to purchase liability because their tenants have GL and name them as additional insured. What is the best sales answer for this objection? So I'm going to assume that they do not have a mortgage on the building, because if they did had a mortgage or a loan on the building, they must have property insurance for the building in place in order to maintain or to even get the loan. So this would have to be someone who owns it outright. If the building burned down, the best argument is that if the building burns down, we're talking GL. Are they only carrying, because the GL is the least expensive portion of a package or a BOP policy for these buildings. So if they're saying they don't need the liability portion of it, I'd make sure that they sign off on it. But the argument, I'm not talking as much about property. Okay, I got it. I already went there, so thank you. The general liability is that if they are sued, and even though they're additional insured, there could be a common area. It could happen outside one of the units. It could happen on a sidewalk. It could happen in a parking lot. It could happen someplace where it's not specifically tied to one of the units, where you could have a trip and fall. You could have someone who actually attacks someone, which is not uncommon these days, and the landlord would be sued. It would be difficult for them to use the tenant's insurance policy as a means to defend themselves if they are the only one sued. It would be quite difficult, and I think that they would probably decline and argue coverage, that there wouldn't be coverage, and that they had no duty, there was no insurable interest represented if they only sued the landlord for some type of loss. So that's the direction I would go, and I hope that answers your question. Go ahead, Michelle.
All right. So again, how I was just saying, all of our carriers do inspections and loss control. So on this one, these are on the slide. There's some characteristics. These are things that would be noted on an inspection and things like that to provide us with a way to make sure we're helping the building owner maintain their property in a way that it's meeting code. It's helping them stay away from a potential loss. So it depends. You can the number of stories your building is. Wanting to know if it's sprinklered or not. In California, now all new buildings, I believe it's 3 stories or higher, correct, Renee? Have to be sprinklered. So each state
commercial buildings. I believe that the building department is requiring all commercial buildings, new construction, to be sprinkled. Period. Okay. I don't think there's any stories. Residential slightly different, yes, but commercial is now being all sprinklered.
But then again, that varies by state. So I was just using California as an example. So the building owner would want to check those requirements, and it also depends on the age of the building as well. If that is not a requirement for when the building was built, then But again, if the building is sprinklered, it's definitely a little bit better for them. It's more appealing to a carrier, definitely. And then if you have uneven concrete walkways or parking lots, so wanting to make sure that's maintained, so you're not having you're creating less of a trip and fall hazard for people that are going to the buildings. And then if it's a multiple story building and they have stairways, and if there's railings for the upstairs, most of our carriers are looking for 4 to 6 inch gaps in between. Anything greater than that is considered a hazard for them. And if it came back on a loss control, they would definitely recommend that the building owner have that, either have the stairway redone so that the gapping isn't as great. That's one of them. And then the biggest thing of all is for a commercial building, all of the markets that we have access to require that the tenants provide the landlord with proof of insurance and that they're named as AI on the tenant's policy. That is something that will be checked at the time of inspection, and if that comes back that they aren't obtaining certificates from the tenants naming them as additional insured, the carriers will issue a notice of cancellation on the policy. So it's something that is protecting the insured by showing proof that their tenants have coverage in place for their business while they're occupying the unit that the building owner has. You can go to the next slide, Renee.
Okay, so let's talk a little bit about building property valuation. So how many of you out there actually just use the value that's on the deck page of the current insurance that you're actually competitively quoting? Yeah, unfortunately that happens because some people don't know how to determine whether the value is adequate or not, so they just use the deck page value, that existing value. So luckily, a lot of the carriers will actually run it through Marshall Swift or their variation of Marshall Swift within their own system, and help with determining the values, because sometimes they are not, they will not accept the value. That's if is in many cases if you want agreed value, or you want some kind of extended replacement cost, you're going to need to meet 100% property valuation for the carrier, and that's going to be their criteria. It varies by every carrier a little bit. So statement of values, when you have multiple building complexes, so you don't have just one building, you have more than one building, statements of value become really important because it breaks down the buildings by unit, square footage, and valuation. And so that becomes a rating factor where they can apply dispersion credits by rating each building separately, and you can get a more competitive premium by having this breakdown. Does the breakdown take a little bit of work and effort to gather that information? Yes. But it by far is, most carriers won't quote otherwise without this information. And so establishing the square footage broken down by structure use is important as well. Not so much more in residential you'll find this, but in commercial buildings you might have a parking structure. Well, you would want that parking structure, or maybe even a warehouse. Those the cost of square foot for the warehouse or the parking structure is not going to be as great as it may be for the other the actual office building unit, because you could have a lot more, you could have marble floors, you could have just a lot of high-tech expensive construction where you would not have that on a parking structure or a warehouse. So you need to know what your square footage is broken down by structure use. Are there any other property components for evaluation? I can't tell you how many times over the years I've seen issues relative to something that was detached from the building itself that no one had taken into consideration, especially backflow pumps that are full of copper. Those losses can get up to $60,000, and you're going, oh my God, how did we forget that? And it's not attached to the building. So anything attached to the building, it would be included as part of the building coverage, and the valuation of that needs to be appropriately valued as well, to include if you've got fences or walls that are connected to the building, then you're definitely going to want to include coverage as part, because it's included in the building value. But anything detached has to be insured as a separate line item. And here's an example. Michelle, you want to talk about that?
Sure. So this is just an example template that I send to agents who they tell me they don't have an SOV, statement of values. SOV is the abbreviation that we use for it. So this is just an example of the document that I send over to people. So it breaks it down by location and building. So you could have multiple locations as well as multiple buildings. It breaks it out, and then you have your other property and structures on there. Lists out garage, carports. I mean, some of it can be geared towards residential, but also definitely we can use it for commercial as well. I do need an SOV when there are multiple buildings. Some of our carriers will offer a blanket limit, but they still need to see a breakdown of how that limit was determined, how the overall total insurable value was determined. But so some of them will offer a blanket. Not all of our carriers do. So that's why we definitely need the SOV completed to show that breakdown.
Good point. Okay, and so the moving target, or the hardest part, is always to know what your square footage should be when you're. How do you determine whether what they currently have is adequate? Sometimes, obviously, our carriers are going to tell us that when we submit it, but it will vary. Like, each of you could be in a different state that's listening in today, and so replacement construction costs, it varies by state. It varies by construction type. It varies by building height and building quality. So those are the 4 factors that go into it. So this is, and we can't go into a lot of this, but I'm going to, and the construction cost per square foot can vary by construction or by structure use. So if you had a garage versus, a high-end, office, a professional office, then those 2 things could have different, the construction cost would be different on both of those, maybe by half. So building valuation is equal to the cost per square foot times square footage, and that's how you get your building value. So what are we talking about? It's that cost per square foot that you're always going to be wondering about. And I'm just going to throw some numbers out there. This is very rough, but I'm going to say, I'd start at $150 a square foot and go up to, when you get into, your higher rise buildings, could get up to $300 a square foot. So somewhere in that range, but your standard office buildings that are not of a high building quality, where you've got marble floors and really expensive wood and things like that, you're going to start at around 150. Is that what you would you agree with that, Michelle?
Yeah, I generally see about 150 is probably the average square footage. Again, a lot of what we get that is in California. So as Anaya had said, it does vary by the state. But yeah, I generally do see 150 is generally the average price per square foot that I see on these types of buildings.
Yes, outside of California, you could drop down to 125. So somewhere in that range, but it gives you an idea. But if you have got a building that's got an elevator, that's got boiler machinery, you've got all types of equipment in there, that's going to shoot it up, and you're going to be well over $200 a square foot. So just food for thought. Michelle can always give you a guesstimate or a direction to go in, and again, the carriers will dictate a lot of this.
All right. So we have the different coverages that are available. These are definitely some main ones that we see. There are others that we can include. So you have property coverage. So that's not just the building. It could be any unattached property coverage as well. It could be your signs and your monuments. If there is a dumpster on the premise that's in an enclosure. If they're not too often that you see garages or carports for commercial buildings, but there could be. Again, that's an unattached structure. So your property coverage is more than just building coverage. And then there's also can be BPP for residence, personal property for the building owner. We wouldn't be looking to pick up the BPP for the tenant. That would need to be on their policy. But again, possibly maybe the building owner provides tables and chairs or outside patio furniture and things like that in their building. So that's owned by the building owner, so it would be considered their BPP. So that would be the property coverage. We can write property as a package with the GL, or we can write it monoline. Again, covering them both with the property and the GL would be the best way to do it as a package to give the building owner the most coverage, but we have the opportunity to write it each one monoline. And then we also have our business income. So you can think of that in terms of loss of rents. that the building owner would lose should there be a complete loss to the building. So generally, obviously, it's going to go off. I go off of the revenue that they generate from the building. But if they're not sure, or it's a new purchase for them, so they're not really sure what the rents are going to generate for them for a year, I generally see one of my carriers who uses this as a rule of thumb, 7 to 10% of the building limit to determine loss of rents. So, if you have the client coming to you and they're just telling you they just want building coverage, well, if you want to try to offer them to show them that you can get some more coverage, loss of rents, and you aren't able to get that information, I would just suggest doing 7 to 10% of the building limit to come up with the limit. So that way you could at least put it on the quote, present it to them, let them determine if they want to take the coverage or not, but at least so you're putting it out there for them as well. And then we have building ordinance and law coverage. There's coverage A, B, and C. Coverage A is loss of undamaged portion. And that, if you are selecting the building ordinance, coverage A would be equal to the building limit. And then there's coverage B and C. Coverage B is for demolition, and coverage C is for increased cost of construction. So for B and C, we can offer the coverage is with B and C having their own limit, or we can do a combined limit for B and C. And is there anything you want to add to those regarding the building ordinance?
Building ordinance, it's an additional premium. It's an optional coverage on most policies, and it's really important that you offer this coverage because as buildings age, especially your older ones, once you have a loss that affects that building, and they have to rebuild a portion of it, the building department is going to say, we want you to put all these additional upgrades because the code has changed, and your insured bought an indemnity policy, and an indemnity policy, insurance policy, brings you back to where you were before, no more, no less. So those upgrades would not be included as part of the insurance, so you would need the building ordinance coverage in order to be able to pay for that. Otherwise, it would be out of pocket.
All right. And then also we can include general liability. Like I said, we can do it monoline or package. As Anae answered the question from earlier, so them thinking as a building owner, oh, we don't need the GL. Well, they definitely need the GL. There is common area on these things in your parking lot, your sidewalks, and things like that. So you can't always put it back on the tenant. So having GL is good for them. And then we can also offer hired and non-owned auto liability as well.
And that's an important one because anyone driving for the landlord or the landlord himself driving his own vehicle. And generally hired is not as important, but the combination of the two is usually very competitively priced. Okay.
All right. So for the GL, I would say 99% of our carriers will not require a deductible. Sometimes it does depend on the risk itself, but for the most part, there is no GL deductible, which is nice. We are able to offer special form replacement costs. That does vary by carrier and also by the risk. So the age of the building, if it's been updated, its location, and things like that. So there are factors that do play into that, but we do have the ability to offer that coverage as long as the risk meets the requirements. We can do 1-2 limit standard. Some of our carriers will offer 2-4 limits, and some of them are not able to, but we can also offer you an excess quote to meet any requirements. Sometimes, loan requirements are asking them to have 2-4 limits, or, the client themselves as a building owner wants to have 2-4 limits. So we have the option to get them to those limits. And then we can do, depending again on the risk, the occupancies in that building and where they're located, we do have the opportunity to do up to 50 million property limits.
Excellent. Okay. we've created a Lessors risk profile to make your job easier. So this is a fillable form. We will be sending that out after the webinar as a tool for you to use. Now, this is for you to gather information in order to complete the Accord application, and generally for Lessors risk, there's a supplemental. So this is not to be, so you could use this with your client to gather information, and we've just tried to summarize all the things that you would need to know in order to fill out your apps and get a quote fast from Michelle. Anything you want to say about this, Michelle?
I was just going to say, it's a good thing to use, you know, if you're on the phone with a client and you just want to jot down some real quick information. I mean, this is a lot of the information that you would transfer over to an Accord. You could also send it over to a prospective client that, you know, has contacted you, have them fill out. I mean, it's pretty basic information. It is a fillable form for everybody, so we make that easy. And then also I would say it's actually probably a good thing to use on new purchases, because we can do buildings that are going in for a new purchase. So if a loan is going to close, you know, they may not have all the details of the building at the time, so it would be a good thing for them to use to try to gather the information about the building, because we definitely, I do get a lot of new purchases that are going through, so I get a lot of loan request type of submissions in that. So this would be a good tool for you. And then on this one, just the best way to get a quote from me, these are the things that I'm looking for. This will actually help me get you a quote faster. So I'm looking for, I need an Accord, 125, 126, and 140. If they're looking for all the GL and the property on the Accords, or even if it's in your email or somewhere, I just need a list of the tenants. So if you're not able to obtain a rent roll from the building owner, that's fine, as long as I just have a list of the tenants and the square footage they occupy. Somewhere either listed on the Accords or in your email, if you have a separate document. I need that information. We do have a supplemental, but we can also quote off of any other supplemental that you may already have filled out for an LRO. If there's any missing information, I'll definitely contact you. And then for loss history, if it's a new purchase, the building owner is not going to have any loss history since they haven't owned the building. The prior building owner's loss history won't affect us, but if they've had coverage in place for, you know, a couple of years, always getting a copy of the loss runs is really helpful for me. If they have had losses, then I would need a description of the loss, know whether or not the loss is open or closed. We do have a much harder time in placing business that do have open losses, and that would, again, be going to an E&S type market if they would consider it. So I would need a description of the loss, and then I would need to know what actions have been taken to try to prevent future losses of that from occurring again. And then if you have a target premium, that's great. If you don't, you don't. I'm going to send you out the best quote that I can offer you.
So we make it easy. Michelle can quote off of any application, but we do have digital applications. We have a Lessors risk application that has everything packaged together, and it's all fillable. So everything you need is right there on our website. So please feel free to go there to get an app. And if there's any questions that you have, I was hoping that everybody asked their questions as we went along, but if you have any, please type them in now. And want to thank you for joining us. Let you know that our website, this webinar will be has been recorded, and it's going to be uploaded to our website, and that's under resources, webinars, and you'll see our upcoming webinars that are future webinars that you can sign up for, and then you'll be able to see there's probably 6, 7, or 8 webinars that have already been recorded, and you can go in and listen to those as if you were here today all over again, because you'll see the visual and you'll see and you'll be able to listen to the training again as many times as you want to. So please submit your applications in to Michelle today so she can get some quotes out there for you. Oops. We look forward to doing business with you. We have a question. Any tips for recognizing building type, JM, tilt up, etc., and roof type? Not very good at recognizing it from Google Earth. Yes, that's a tough one. Do you have any suggestions on that, Michelle? Because you're
I mean,
more
it is
hands-on.
definitely, it is a tough thing to determine because you're not seeing, obviously, there could be stucco over the building, or, a building could look like it's possibly brick veneer, but really it's not, just because they have brick or stone on the outside. So knowing the construction type is definitely a harder thing to determine just by Googling it. I do Google all the risks that come in to try to obviously take a look at where it's at, what the tenants are and things like that, just to kind of get an idea of the building. But, frame is going to be our highest rated construction type. So, I mean, a lot of things, most things in California are frame, so frame is generally the case. But, I mean, it's not really something you can tell from just Google mapping it. So if your client isn't sure, I'm sorry, go ahead, Renee.
A lot of what they're building today, so let's talk Lessors risk. If you're talking about a professional building, a professional office building, you're definitely into frame construction. Unless you're going into a high-rise where you've got, it's a strictly steel structure, you know what I mean? But there's going to be frame. You're going to see wood as part of the structure. Joisted masonry, you don't see as much of, like, it's mostly masonry veneer. It looks like it's masonry, but it's not. There's a frame structure underneath it. So I would, if you want to be safe, I would, unless you can see that it's a concrete tilt up, and they are building a lot of the more commercial or retail structures. Some of them, they're just putting those concrete walls together, but it depends on what they're joisting them together with. So if they're using any kind of wood construction, you would be safer to go frame. So rather than, because once they do the inspection, you're going to get caught, and they're going to increase the premium based on what the inspection truly turns what the structure turns out to be. So that would be my rule of thumb. And now, as far as roofs are concerned, most of what is the biggest concern in the industry is obviously anything that has, and you're not going to see wood shake on a professional, well, however, you could in some states, not so much in California, but in some states, and in California, you could see wood shake on an older building. Newer buildings are not being built that way, period. But if you're dealing with an older building, that's possible. So that's the biggest concern. Wood shake is an absolute no-no. So the rest of the roof construction, you give it your best shot. And I don't think that, I've never seen the roof component be a rating factor that's going to change the premium. So I wouldn't worry so much about that. Right, Michelle?
Yes, I agree with that.
Okay.
To answer the last question, the webinar will be posted later today, and then we will also be sending an email to everyone that attended, and you'll get a link to that as well. So the webinar will be posted, and probably in a couple hours after we close out our session today.
Perfect. Thank you guys for joining us. I hope that this was of value. We love feedback. There's a survey, so please give us some feedback because we want to do more to assist you in writing a lot of commercial business, and hopefully with us. We'll take good care of you. Have a good day.
Thank you.